Hello, everyone. Hopefully you successfully navigated entering into the Zoom webinar system. Welcome to the McCombs School of Business at the University of Texas at Austin. I'm Scott Bogus. I'm the director of the program on financial markets regulation in the school's newly established Salem Center for Policy. We wanted to thank you for joining our PhD student symposium today. We have in store for you what we think is a terrific lineup of speakers. They come from government, industry, and academia. And the goal of today's symposium is to help all of you in your research programs. Before we begin with our first panel, I want to share some background on how this event came about, and perhaps that will set some expectations and how you might benefit from the activities. Before joining UT faculty last year, I spent more than a decade at the Securities and Exchange Commission. And during that time there, I was involved in a large number of financial policy decisions. And my role as an economist was to apply economic principles and the available empirical evidence to inform the commission on the best direction of the policy actions. I found that to be a very rewarding and exciting experience. And because of that, I turned to what was a one-year visiting scholar position in 2007 into a permanent position that lasted 12. And during that time, importantly, I learned how to consume academic research. I would be probably not telling the entire truth if I said that all policy decisions were evidence-based. It wasn't just a result of the political forces. On many occasions, there was just a disconnect between what policymakers needed and what academic researchers were producing. And in short, there was a lot of good research questions that were going unanswered. And the problem that I saw was that a lot of relevant research questions weren't reaching enough researchers. When you're in government, you have a front row seat to research ideas. They come by way of meeting with market participants and industry groups. They come in, they explain their problems, and they give their views on what to do about it. It's like, to a researcher, it's like playing the game of Jeopardy. They would be feeding you the answers to yet identified research questions. The problem was most academics didn't have access to that front row seat. 2 years ago, while I was still at the SEC, we tried to do something about that. We invited a cohort of emerging scholars from PhD programs from around the country to meet with SEC economists, lawyers, and agency leaders. The idea was simple. We wanted to expose students to active policy issues and the challenges in solving them, then discuss and answer questions about potential research ideas. And the goal was to inject institutional knowledge into emerging research programs in a direction that ultimately would benefit federal policy. The demand for that program at the time far exceeded expectations, and by most accounts, I think it was successful. And so we're doing it again. But this time, there's an expanded scope of participants, including several officials from the Federal Reserve System, the Board of Governors, industry experts, and of course, leading researchers from academia. So today, in the morning for the plenary sessions, you are going to learn how academic research is helping to navigate the current COVID crisis, as well as how COVID-19 may itself be shaping the research process. You will hear from current and former editors from leading journals. They will share their views, not only on how to get published and navigate the editorial process, but they'll include how they think about the policy impact of their decision-making. In the closing plenary session, you'll hear from the current SEC Chief Economist, S.B. Kotari, and he's going to moderate a panel of three former chief economists on open policy issues in securities markets. This afternoon, at least for, I guess, those of you in the US time zones, we will transition to special track sessions. These are designed for those of you in the advanced stages of your program. And in the first session, you're going to interact and engage with former regulators on how they use and produce academic researches for policy purposes. And you'll also have an opportunity to engage with them on open questions about your research interests. In the second special track session, our academic track chairs have selected from a large number of working paper submissions. And so we're going to hear about what you are all producing. In the closing sessions, you can choose from among 4 special topic panels designed to provide institutional knowledge in active areas of research that is important to ongoing policy issues. All right, so before I pass it over to our first panel, just wanted to offer a couple of business items. First, in the morning plenary sessions, you are free to ask questions. To do that, use the Q&A function. Simply type in your questions, preferably as concisely as possible, and the session moderators will work to add those to the discussion. In the afternoon sessions, the default upon entering is your video will be turned off and your sound will be muted, but you will have control to change that. We hope those sessions will be more personal and interactive, and your session moderators will announce preferred format in order to make that happen. Finally, again, we thank you for entering the program, joining today. You'll be getting a short survey afterwards. We'd like to hear what you think was useful and what wasn't. We hope to learn from this event and hopefully offer future opportunities for emerging scholars. Okay, so without further ado, we introduce Sheridan Titman, the Walter McAllister Centennial Chair in Financial Services here at the Macomb School of Business, and he is moderating the first panel on the role of academic research in navigating the current crisis. Sheridan.
Okay, am I unmuted now?
Yes.
Okay, great. Okay, thank you very much, Scott, and welcome you all to the University of Texas Macomb School. And I'll be moderating what I hope is going to be a very interesting panel on the role of academic research in navigating the current crisis. I'll start off by just mentioning two things that I think are very interesting about this particular crisis, at least from the perspective of an economist. This is one of the only cases that I can think of where we've got a major shock that I would view as purely being exogenous. You know, we know about past shocks like the financial crisis in 2008. We don't want to view that as an exogenous shock from the perspective of financial economics. It's a shock that comes from the financial side, not a shock where the financial side is reacting to a shock. So this is one of the few shocks that are both major and purely exogenous. The other thing that I think is interesting to note is that this is the first time that we've seen a very large fraction of the economics profession mobilized to address a real world problem in real time. We of course expect our colleagues in the medical schools to be mobilized very quickly to do things like come up with vaccines and various ways to treat a disease, but we're also seeing very deep analysis of policy proposals in real time. So as a profession, we're reacting much more quickly in this crisis than ever before. Now, as students, you might be concerned that by revealing that it's possible to write a paper in less than a month, we may have moved the bar for what we expect from your dissertations. But hopefully you're going to see lots of opportunities for research, which we're going to be discussing on this panel. So we have three very good panelists, very renowned panelists. We're going to start with Jeremy Stein, and Jeremy is the chairman of the Harvard Econ Department. He holds the SAFRA chair and was formerly on the board of governors of the Fed. Now, Jeremy will start off with a brief review of the initial reactions of the US financial markets to the crisis, how the Fed responded, how other US policymakers responded. He's going to be followed by Tobias and Adrian, and Tobias is the director of the Monetary and Capital Markets Department at the IMF. So Tobias is going to follow up on what Jeremy was saying, but give a more global perspective. And we're going to end with Jim Paterba. Jim is the Mitsui Professor of Economics at MIT, and he's the president of the NBER. Jim is going to talk about the financial side, but also more on the real side of the economy, and talk more about policy responses and research opportunities. So without further ado, I'll turn it over to Jeremy to get us started off. Jeremy?
Okay, well, thank you, Sheridan. And thanks for including me in this. It's a pleasure to be with all of you. Let me see if I can share my screen. Okay, So what I thought I would do is, can you all hear me okay? Yeah, okay. What I thought I would do is try to say a few words about the programs that have been rolled out in recent months by the Fed and the Treasury. One thing that was remarkable about this crisis is how rapidly the authorities responded. And if you'll recall, in March, as markets were starting to really wobble, the Fed and the Treasury rolled out a whole array of programs. I'm going to be focusing primarily on the longer run credit programs. This is what's come to be known as the Main Street program and the primary and secondary market credit facilities, which are bond buying programs. And again, they were rolled out very quickly. It's natural to some extent that they were built upon the playbook of last time around. And I guess the basic fundamental takeaway, the one thing I want you all to sort of remember is that we're facing a very different, as Sheridan said, a very different set of circumstances than we faced in 2008, 2009. And as a result, the sort of design theory of the case is fundamentally different. And there are limits to what we can do by building on kind of the conventional logic of financial market intervention. So let me start with the sort of classic logic for central bank intervention, the classic lender of last resort. This goes back to Bagehot, who was writing about this, a couple hundred years ago in the UK. And the idea is that what is the fundamental role of a central bank in lending to the banking system? It's to deal with liquidity problems. And if you want a modern kind of incarnation, a modern theory that makes this all sound sensible, it would be something like the Diamond-Dybvig bank run model, where there's a good equilibrium and then there's a bad equilibrium with a bank run. If you lend aggressively as the central bank, you can stop the bad, you can essentially eliminate the bad equilibrium. In the good equilibrium, banks and their clients are fundamentally solvent, and so you can pay back. Okay? So basically, the idea is that you're dealing with firms or banks that are fundamentally solvent, but are facing an illiquidity problem. And given that, it makes sense to lend, and to lend, as Bagehot had originally said, to solvent firms at good collateral and at a penalty rate, i.e. secure your position as the government, expect to get paid back in full. Okay, now, this is a caricature, but with hindsight, to some extent, you can characterize 2008, 2009 this way. As many of you know, the government put out an enormous amount of resources to the banking sector, but they were essentially paid back in full. So again, with hindsight and with a bunch of good luck, 2008, 2009 looks to have, at least in significant part, been a liquidity type of event. Okay, and so this approach to lending, arguably made sense. And again, my sort of one overarching point is this is not 2008, 2009. And if you sort of frame the policy response around this bank run theory, you're not going to get it right. And the magnitude of the shock and the uncertainty of the shock are such that it's just wrong to think of this as primarily a liquidity event. I think the two kind of stylized facts I think one wants to bear in mind when thinking about policy design. First of all, there's just very, very first order uncertainty. We don't know how long the emergency will last. We don't know when there'll be a vaccine. Even when there is a vaccine, we don't really know much about what the new world order will look like. Will business travel be fundamentally different forever? Will hotels, there's a whole number of industries that you can imagine being reshaped. Second of all, we as economists tend to toss around the word solvency a little loosely, and often we tend to associate financial distress with economic distress. And well, if they're a zombie, if they're not making any money, we should sort of put them out of their misery. And normally it's loose, but it's not totally crazy, because if you have a firm that basically is not making any money for 12 months and can't pay any of its debts, you probably think its long-run viability is not great, and it makes sense to essentially put the firm out of business. That's much less obviously the case. In other words, the correlation between short-run measures of solvency and long-run notions of economic viability probably much, much less. So, again, as an example, none of us probably went to the dentist for the last 4 or 5 months, probably terrible for the economics of dental practices. Does that mean that dentists are not going to be viable in the long run? I hope for all of our sakes that's not the case. So what are we hoping to do here? There's sort of micro level and macro level objectives. At the micro level, I think we'd like to ideally prevent, as in the dentist example, the destruction of sort of valuable capital, physical and organizational. That's not to say you're trying to shield investors from losses, but one has to recognize, certainly for small business and to some extent for larger businesses, the technology we have for allocating losses is not ideal. And even Chapter 11, which you might think is supposed to do this job, there's considerable good micro evidence that Chapter 11 works less well when the system is strained and essentially when courts and judges are overloaded. So even if you sort of are willing to rely on a Chapter 11 type of system in normal times, there may be some benefit to not having an enormous wave of bankruptcies in a relatively short period of time. So here is how we're thinking about, how some of my co-authors and I have been thinking about this, which is rather than take this lender of last resort kind of mentality, where it's all about essentially the government having a senior secured position and seeking not to lose any money. And by the way, it's notable that Treasury Secretary Mnuchin in the early days of the programs basically was quoted in the paper as saying, we as the Treasury seek to not lose any money on our lending programs. I think that's just not the right approach. In a situation of very, very high uncertainty, I mean, think what does the private market do? So think of venture capital. And by the way, I'm not using venture capital here in the picking winners sense of the word. I'm using it in the sort of security design sense. So in other words, facing a given firm that you'd like to lend to, knowing that there's a lot of risk, how do you design the financing arrangement? In circumstances like that, you don't say, I'm going to lend to you and expect to get paid back 100%. Rather, you control your exposure by putting out a little bit of money. The flip side of high uncertainty is high opportunity for learning as time passes. You put out a little bit of money today. As time passes, if we branch to the more optimistic branch of the tree, that is to say, if we learn, let's say that a vaccine is imminent in the next 6 to 9 months, maybe at that point you're willing to put in more, but you control your exposure by not giving firms a year or 2 years worth of money all up front, okay? And at the same time, of course, you have to be willing to lose some money, because if you hit the lower branch of the tree, you're just gonna lose money. So I think the basic principle that this kind of suggests is you don't impose very stringent credit type of standards ex ante. You don't say, I'm only going to deal with high investment grade firms. You can do that and you can protect yourself from losing money, but of course then you won't be touching the firms that the planner most cares about, okay? So instead you protect yourself with staging. The other thing is I think it's a mistake in these circumstances to use very senior claims, to use hard debt. Because think about it, again, we have a lot of uncertainty. Even if there is a vaccine, even if we get past that stage, do you want the firms that you've helped emerging with heavy debt burdens and aggressive principal repayment schedules at a point when the economy is still fragile? I think you would ideally prefer, and this is something that was done with the banks in 2008, 2009, you didn't want the government to lend literally with debt to the banks because they were undercapitalized. So instead, they were financed with a preferred claim. That made it easier to essentially postpone dividend payments if need be without creating bankruptcy. It made it easier for them to raise new financing without the classic sorts of debt overhang problems. And if you want to, again, strengthen the government's position, rather than pushing for more seniority and security, you can try to take warrants to capture a little bit of upside. So again, a lot of this is just trying to import some of the things that we know about financial structure from things like venture capital and have that be sort of the way you think about the government's financial position as well. Okay, I won't get too much into the details of the existing programs given the time. I just wanted to point out one aspect that I think is potentially problematic for the Main Street program, which is, again, in an effort to protect itself, the government has decided that it will only lend side by side with banks. That is to say, if you want to get a loan, if you're a firm and you want to get a loan from this Main Street program, the government will fund 95% of the loan, but 5% has to come from a bank. And I guess the underlying idea is the government wants to free ride to some extent on the bank's underwriting capabilities. They want the bank to have screened that this is sort of an okay borrower. The problem is I don't think things are aligned well for the banks to effectively do that screening. And that's for two reasons. First of all, the social planner wants to make some loans that the banks will not want to make, precisely because we're trying to deal with a variety of externalities. So on the one hand, I worry that if you bring the bank a fresh new customer that they haven't dealt with before, they won't be very inclined to make the loan, even if in some sense the planner thinks that that's a positive NPV thing to do. So you may get underlending in those cases. On the other hand, if you think about a situation where the bank is already in for, say, 100 units to a firm, and that firm is performing poorly, and now the bank is thinking, how do I bail myself out? Well, at that point, they might be quite happy to put in 5 if that allows the government to put in another 95 and thereby help keep the firm alive. So I think you don't really get very good selection necessarily out of having the banks involved, and you get a bunch of other impediments. And it's worth noting that at least in the early days of the Main Street program, there's been very little lending, and at least anecdotally, some part of the problem seems to be that the banks just don't want to participate. So I think that's something that's not obvious you want to have. Let me stop there and leave time for everybody else and hopefully for our Q&A. Okay, Sheridan, I'll pass it back to you. Thank you.
Okay, thank you very much, Jeremy. Tobias, could you give us more of a international view?
Yeah, absolutely. Sorry, I switched my camera to the wrong direction. So thanks very much for including me in this panel. And thanks, Scott, for organizing. Thanks, Sheridan, for sharing. When we were coming out of the 2008 crisis, I sort of thought that we couldn't see another major crisis for some time. And here we are, and it's very large and very different from the 2008 crisis. So I want to give just a little bit of an overview of my thinking of macro finance in this crisis. And so the backdrop for what I want to talk about is from the World Economic Outlook. So actually 4 times a year, the IMF gives a forecast for every single country in its membership, which are 190 countries. And so here I'm showing you advanced economies, which are like, the US, Europe, and Japan, and emerging markets and developing economies. So the world is split up into 2 parts. And what I wanted to focus on is the blue first. Those are the advanced economies. So the blue dashed line is the forecast for global growth as of January. And then the blue solid line is as of June, so 6 months later. And you can see there's this massive drop, right? In January, nobody expected, we certainly didn't expect that there was going to be this massive economic crisis triggered by the COVID pandemic. And there is a recovery, a partial recovery, and it's very lopsided. So even at the end of 2021, we still expect there to be massive output gaps for advanced economies of the order of 6% of GDP. And for emerging markets, excluding China, even larger, close to 8%. China, of course, is very large in the emerging market universe. And it is an economy that we do expect to recover fairly quickly. This is sort of like the one outlier in the whole world that is going to probably recover fairly quickly. Everybody else is going to be, severely distressed for a long time. And of course, as economic actors were realizing what was happening, starting in February and then in March, as the pandemic was spreading the world, markets sold off massively. So you can see here the market sell-off between January 17th and March 23rd. So January 17th is when sort of like the first news of the pandemic was trickling out. And March 23rd is the low point of the US and global equity markets. And March 23rd is exactly the day when much of these facilities that Jeremy was talking about were announced by the Federal Reserve. So all these lending programs and the corporate bond purchase programs in particular were announced on March 23rd. So that was the turnaround in terms of asset valuation. So what you can see here, for example, in the left chart is that for Euro equities, emerging market equities, S&P 500, Nikkei, they all sold off about 30%. And then they recovered pretty much everything, right? Of course, some sectors have not recovered. Again, hotels and restaurants, airlines, energy sold off close to 50 or 60% globally. And they did not, they recovered to some degree, but not the whole losses. And of course, spreads also widened dramatically, but then came in very, very rapidly. So what you can see is that here on the left-hand chart, these are the equity indices for the S&P 500, the investment grade bond ETF, and the high yield bond in the ETF. All of this is for the US. And you can see that the S&P 500 didn't recover fully, but of course, if you look at different sectors like tech, more than recovered, is actually up 20%. Some other sectors fully recovered, while sectors like airlines and restaurants have not recovered. The investment grade bond universe has recovered more than what it lost. And so this is pretty unusual that you see such a sharp sell-off, but then such a sharp rebound of asset prices so quickly. So what has happened? And what I would like to put forward here is that it's really the intervention of policymakers, both central banks and treasuries around the world, that has been extremely aggressive, very large in size, and very fast. So the left-hand chart shows you the G10 central bank assets, okay? And you can see that within 3 months, the G10 central bank assets increased by $6 trillion, okay? This is extremely fast, extremely aggressive, and it is much quicker and much larger than what happened in 2008. And it's not just the advanced economies, it's also emerging markets that started to do asset purchases, which is shown on the right-hand side. But it's really the advanced economies, in particular the Federal Reserve in the US, the ECB, and others that very quickly, very aggressively acted. And so what you end up with is an easing of financial conditions. So the left-hand chart is a composite financial conditions index. So this is kind of like the price of risk in the economy, right? So if you have a macrofinance model with an endogenous price of risk, you can think of the financial conditions index as the price of risk. And this is broken down here into the US, Euro area, China, other advanced economies in the emerging markets. And you can see that there was a very sharp tightening of financial conditions in January, March, February, but that has nearly entirely reverted. And so financial conditions tightened, but never as much as in the global financial crisis, and they reverted much more quickly than in the global financial crisis. So what is different? And I think this is really the research question is, how is this crisis different? Why is this not a financial crisis at the moment? And I think there are these two elements. So one is the very aggressive policy response. I already mentioned the $6 trillion central bank intervention that was coupled with globally a $12 trillion fiscal policy intervention. So very large, very quick as well, and even larger than the central banks. And so what you end up with is a kind of disconnect in between market valuations or market sentiment on the one hand and real economic activity, right? So output is not expected to recover fully, right? It's very lopsided. So the left-hand chart, for example, shows you the earnings forecast. It's true that earnings are expected to come back, but they don't fully make up for the recovery. But at the same time, of course, these stock indices have fully recovered, in particular for the top 5 stocks, which are all the tech stocks. And so you have a kind of a tension here between the real and the financial. And you know, I think that is a great question, is to understand, you know, why is it that you have this very, very sharp recovery in asset prices while real activity is very depressed, is expected to be very depressed for a long time. And as Jeremy pointed out, there's expected to be quite a bit of insolvency in the corporate sector. In terms of emerging markets, this is even more incredible in some sense, the story. There was a very sharp emerging market sell-off in March. And since then, capital flows to emerging markets have come back. So the easing of global financial conditions was so tremendous that even for emerging markets, when you look at their yields, either in local currency yields, so where they're funding in their own domestic currency, or in terms of hard currencies like in dollar funding, you know, the local currency yields are actually lower today because of the very aggressive monetary policy actions. And the hard currency yields are somewhat higher because, of course, spreads have widened in terms of dollar spreads for emerging markets. But the overall level of yields has come down quite dramatically. So the funding conditions have tightened a little bit for hard currencies, but they're not all that tight. And a lot of the tightening has been reverted, so capital flows have come back. Now, of course, there is a tremendous fiscal policy response. And that means that debt to GDP is going up very quickly all over the world. So the left chart, for example, shows you how corporate debt and household debt is going up all around the world. And of course, the problem with the central bank interventions is that typically they provide more leverage in an environment where equity buffers are being eaten up. So you end up with a more highly levered corporate sector than you had before the crisis. And the question then is, which firms have to be restructured, which have to be recapitalized, which have to be resolved. So the very last thought before turning back to Sheridan is that, of course, you know, this crisis has started off with a banking sector that was a lot better capitalized than the 2008 crisis, right? I mean, capital is a lot higher in banks today than it was in 2008. And so what I would like to put forward here is the hypothesis that it's the combination of high capital in the banks and very aggressive policy intervention that has prevented the very adverse macro-financial feedback loops to kick in for now. But of course, this crisis is going to last a while, and we might see a financial crisis in some countries and banking distress in some countries going forward. So with that, let me turn back to Sheridan.
Okay, thank you very much, Tobias. And we'll end up with Jim Peterba, who will hopefully give us more on the real side of the crisis. Jim? And you're muted, Jim.
Thank you very much, Sharon. It's a great pleasure to be here with you all this morning and to have a chance to talk about some of the policy responses and research responses to the remarkable COVID-19 crisis. I'm going to pivot from one of Sheridan's comments at the very beginning, which is the observation that we've seen a dramatic research response from the economics and finance community to the developments of the last few months. And it's very different than what we saw in, say, 2008, 2009, as the global financial crisis unfolded. Part of this may have to do with the difference between the two shocks, right? The 2008 crisis really began as a shock in financial markets and then gradually impacted the real economy. The 2020 shock began as a very clear shock in the real economy. And then the exciting challenges were to figure out how it was jumping into the financial markets and what the consequences would be there. I think it is easy to lose sight as we've lived through the last 5 months of just how dramatic the real changes in the economy were earlier this year. Okay, in the more than 70 years since the current unemployment rate series for the United States was maintained on a consistent basis, there were 3 months prior to January of 2020 when the unemployment rate changed by more than 1% from 1 month to the next. Okay, in April 2020, the unemployment rate rose by more than 10 percentage points. Okay, this was a 48 standard deviation move relative to the historical experience, right? So it is absolutely unprecedented, and using standard statistical tools, the sort of thing you would never ever expect to see happen. We've had 3 moves of more than 1% since the beginning of the pandemic crisis, and of course the April shock was truly extraordinary. So what's amazing is that the research community has jumped in to try to study this question, and one metric for that is there have been over 225 NBER working papers on the COVID-19 crisis since the middle of March. That is, about a quarter of the typical annual all topics, all field production of research, and it is only a small fraction of all the research that's been done by the economics and financial communities, research communities globally. So it's an extraordinary thing. And I think one question we might just ask is, well, why? What's happened? I mean, partly it's just that usually doing high frequency research is not terribly exciting because not much happens at high frequency, right? But when dramatic things happen very quickly, there really is this need for what I'd almost call battlefield social science, which is trying to dive in and figure out what can we say, how can we inform the policy issues, okay? There has been demand for guidance on policy topics, on a variety of both monetary and fiscal policy topics, as well as financial regulation. And there have been many new and unprecedented issues that we've had to try to think about, right? Thinking through the trade-offs between shutting down the economy, the lost jobs versus the lives saved, the illnesses avoided, tracking households with novel financial stimulus that's been provided, thinking through the new Fed policies and the old Fed policies which are being used in a new setting, and of course, looking at the consequences of a variety of fiscal stimulus actions. So in the face of all this, I think the way I would characterize the way the research community has responded is by trying to find any real-time data that could be used to describe and track the consequences of what was happening. The standard sources of government-provided data, many of the standard household surveys, just appear on a time scale that has made it difficult to address the questions people were interested in. And one of the key differences between 2020 and 2008 is that the research communities in both finance and economics have made much greater inroads into working with private sector data, administrative data from governments in the current environment than they had 12 years ago. And that has been invaluable because it's been the key source of information for tracking a lot of the aspects of the economic and financial impact of what's happened in the last 5 months. So what I want to do this morning is just to illustrate a few of these research studies to give you a sense of what's happening, what's being done. They are almost all based on microdata, so they are very complementary to the type of aggregate analysis that both Jeremy and Tobias were just talking about. They almost all require some significant work on the part of the research teams to be able to navigate and negotiate and get access to these data. But I think they will illustrate the richness of what can be done when one has access to this kind of information. So I will start by talking about several issues on the real side, like job losses and business closures. I'll move to some topics in household finance, consumer spending, saving, and the maintenance of liquid assets. Then I'm going to talk at the end about a little bit on the financial market side, impact of the Paycheck Protection Program, which was designed to keep firms afloat, and then some of the evidence on financial market flows that we've seen. And this will just be, it's a thumbnail sketch designed to give you an idea of what's been happening without diving deeply into any of these topics. So, the first issue, of course, is what's happened to employment. We have the aggregate information from the current population survey that tells you that we've had a gigantic spike in the unemployment levels in the aggregate US economy. We have data from unemployment insurance filings at the state level that tell us about the number of people who are trying to get unemployment benefits. Those data, of course, are sometimes confounded by difficulties of processing the applications and other things at the state level. We also have information from payroll providers like ADP, a major US firm that handles the payrolls for large numbers of firms, especially larger firms, that provides us with some real-time information on what's actually been happening in the labor market. So the graph I'm showing you here just does two different things using access to these ADP data. And some of the, I will note that some of the authors on many of the papers I'll show you are actually employees of the firms that maintain these data, partnering with the academic research teams or researchers at the Fed to try to study these questions. So what the ADP data show you is not just what we knew already, which was that employment declined, but it also gives you some texture on the nature of that decline. First, in the left-hand slide, you can see that as we move from mid-February to mid-May, the sharpest decline in employment, the almost 30% decline, was at the smaller firms, 1 to 49 employees in this case. That larger firms, more than 500, employment declines were more modest, never falling below 20%. On the right-hand side, we see that we learned something about the nature of where the pain in the economy has been, and that it is disproportionately the lowest wage workers in these firms who are suffering the employment loss, right? So once you've got the micro data on this large number of firms and their payroll records, you can address questions like the ones that are shown here and try to understand what's happening within the economy. This is something which, you know, with enough time, publicly accessible survey data would become available to address questions like where in the wage distribution did the pain of job loss fall. But the ADP data were often available faster. And in many cases, the sample sizes are much, much larger. So one thing we've discovered about working with these private label or other administrative data sets is, you know, in many cases, you can ask more refined questions than you can with the traditional survey sources, simply because you've got a lot more observations and a lot more data to look at. And a leading example of this is work by Raj Chetty and his colleagues at Harvard, who have done things working on geographical disparities, looking, for example, at zip code level information on job loss and on other types of things under the umbrella of the Opportunity Insights platform, which is based at Harvard. I'll say a little bit more about that in a couple of minutes. Second question one can look at, linking over to the business side. We know that small businesses are important sources of entrepreneurial activity. One of the big questions as this crisis began to unfold was how those businesses would fare. These are data, these are from actually a standard public use survey, the current population survey, looking at the number of self-employed business owners as we move from February into April into May. What you can see is that there was a sharp decline, particularly for the unincorporated business owners, a drop of more than 25% in the number of self-employed business owners reporting any activity. Even for the larger, more incorporated businesses, a decline of 14%, some gradual decline, some gradual increase after that. What I don't show here, but the data also enable us to study, is aspects of the demographic and racial and ethnic differences in the impact of this crisis. And if I were to disaggregate this and show you the differences in business owners by race, for example, Black and Hispanic owners are much more likely to be impacted, much deeper decline than the aggregate decline for the economy. So one begins to draw a picture of what's been happening in the economy as this shock has rolled out. Okay. Another question one can ask is, what about the spending side? Very rich database, which is being used here, is the JP Morgan Chase Institute data. This is a combination of credit card clearings, debit card charges, and potentially also can be linked with check writing and other information for those who have bank accounts. This is a huge micro data set on the clients of JP Morgan, basically, which has been harnessed through the vehicle of the JP Morgan Chase Institute, a piece of the JP Morgan complex. But a number of academic researchers have partnered with JP Morgan to analyze and to work with these data. What these data show us, because they're tracking high frequency consumer spending, and they're able to show us that spending data long before the national income accounts are reporting personal consumption expenditures, is what's happening to spend. Okay, so you can see, for example, the decline of nearly 40% in between 30 and 40% in spending between late February and early April, in terms, or mid-March and early April, relative to a year ago. Okay, and then you can also track, and again, this is the richness of the microdata, the rebound in these spending levels as a result of federal stimulus payments, and then just the differences by income group. And what is really amazing when you look at these data, right, is there's this dramatic decline, which is relatively well spread across all income groups. But then as the stimulus payments begin to roll out in early April, you see this pronounced rebound in consumer spending, so that today, relative to where we were a year ago, what you've basically got is very similar levels of spending for the lowest income quartile, modest reduction for the second and third quartiles, and it's actually at this point the highest income quartile, which seems to have pulled in the most in terms of its spend relative to the past patterns. Now, of course, this is where some of the household finance begins to intersect with this, because of course the highest income quartile is the least likely to be credit constrained, the least likely to be operating on a hand-to-mouth type consumption model, and the most likely to have the financial resources to buffer the kind of shock that we're experiencing here. One of the other interesting discoveries that emerges from this type of data is that there's been a rapid increase in average daily household balances, checking account balances, and other things like money market funds in the course of the pandemic. Right? These are data that show you, starting from the March 13th declaration of the national pandemic, what you see is that for all of the income quartiles, there's been a sharp increase in these daily balance measures. People have been saving more, and they seem to be accumulating essentially in their cash or almost cash equivalent sources of asset. And strikingly, the largest percentage increase here is for the lowest income quartile. Now, of course, that's both a numerator and a denominator effect, because starting out for that group, the balances were the lowest. So it's not that hard to get a large increase in terms of the required absolute amount of balance. But even for those who are at the highest ends of the income distribution, we seem to be seeing a quite substantial increase in their balances. This is an example, I think, of something which is a new development that's playing out during the course of this pandemic, and where a great deal of research can be done prospectively on trying to embed the kind of simple stylized patterns that I'm showing you here in our standard life cycle models, our models with credit constraints, our models of differential access to financial markets, and to think about the way in which households have behaved as they've navigated this crisis. Okay. One other consequence of the real programs I want to talk about, and this is in terms of the impact of stabilization policies like the payroll protection program. One of the features of a lot of applied micro research lately has been trying to find sources of identification where some firms are eligible for a program, some firms are not. Some individuals are eligible for a program, some are not. The PPP program was limited to firms of certain sizes, which meant that there is a sharp discontinuity as you look at the number of employees in the eligibility of firms to take advantage of this program. And as a result, this provides an opportunity for identification as folks can look, for example, at the difference between the likelihood that people were still employed at firms that were and were not eligible for the PPP program. This is data from Raj Chetty and his team at Harvard, which seems to suggest a relatively modest impact looking at that source of identification of the PPP program. This is using data from from a business services provider named Womply, which makes its data publicly available for researchers who'd like to use it. Womply tends to serve very small businesses. So while it's a rich and large data set, it is not a fully representative sample of US firms. And one of the things that we've been discovering in working with these private sector and administrative data is that samples can be large without being representative, right? So for example, in the PPP case, it appears as though the Womply and the ADP data, ADP based on larger firms, suggest somewhat differential patterns in terms of the impact of PPP. And in particular, the ADP data suggest a larger impact. Well, that may have something to do with whether the small firms were not going to make it anyway, and even the small but not so small firms are across a margin where there isn't that much difference. What I've mostly focused on in the last few minutes is really on the real side. I do want to illustrate, because this is a finance-oriented group, that the same things have begun to emerge in looking at the research on financial markets and the kind of dislocations that Jeremy talked about in his presentation. Just to give you one example, This is a study of the net flows to corporate bond funds and ETFs invested in corporate bonds. One of the dramatic changes in financial markets since 2008 has been the growth of corporate bond and especially ETFs investing in not completely liquid assets, but trading in liquid markets. And a concern, of course, is the liquidity mismatch there. There's also an issue around mutual funds of knowing about the liquidity rule and the extent to which they are actually providing adequately for liquidity shocks. This is information drawn from Morningstar data on financial flows, combined with Thomson Reuters Lipper data on the holdings of different funds by Falato, Goldstein, and Hortoksu in a recent working paper, documenting the dramatic increase in outflows that took place from these funds for not just a day, but several days spanning almost 2 weeks in late March. And of course, understanding the consequences of this kind of an outflow links right back to Jeremy's comments on thinking about the Fed provision of liquidity and what was happening to try to reassure markets at a time when investors were fleeing certain assets which seemed particularly exposed to the consequences of the crisis. So I will close by just saying, I think, for those of you who are beginning your research careers and thinking about what emerges from this crisis, I think there are two things to take away. First, there are new questions to study. And as data becomes available, we will learn more about things like the impact of PPP loans or the impact of some of the recent Fed interventions in how they've affected liquidity in various markets. But don't forget that there is also a wealth of new variation that can enable us to study old questions. So for example, the impact of more generous unemployment insurance benefits on job search and job finding, the role of different financial intermediaries in providing liquidity during a crisis. These are questions that are long studied issues, but because of the really extraordinary changes we've seen in the last 5 months, we're going to have a lot of new opportunities to study those questions going forward. So thank you very much.
Okay, thank you very much, Jim. What I'd like to do is just open a little bit of a discussion amongst us. And I want to touch on two main questions. The first is the fundamental question on, in some sense, on what is happening. What a few of you have mentioned as a sort of a disconnect between the financial markets recently and the real markets. And the other is I want to have a more general discussion of research opportunities for the PhD students here. So in terms of the fundamental disconnect, I think Jim put it well. The 2008 crisis was a shock to the financial system that migrated to the real economy. So it seems that if we've got a shock to the financial system, and that's what's causing the problem in the real economy, that seems like that's something that should be relatively straightforward to fix, and that some sort of Fed in policy intervention should be able to get the financial system back on its feet, which will get the real economy back on its feet. What we're currently facing seems a little bit more complicated to me because it's a shock to the real system, and there's nothing that the Fed can do to get people to stay in hotels and get back on airplanes. So it's only basically addressing the problems with the financial system that's caused by the real effects. So what seems a little bit surprising to me is that the markets have responded much more favorably to policy interventions in this case, where it seems like policy interventions should be weaker than in the 2008 case. So maybe I'll send it back to Jeremy to start. Why do you think the markets responded as strongly as they did? Does it seem rational to you?
Yeah, well, so this is just, I'm glad you raised this, and Tobias, I thought, described it really well. I mean, this is a sort of remarkable example of, I guess, what you might call central bank magic, which is, the classic kind of central bank magic is Mario Draghi saying, several years ago, we stand ready to do whatever it takes, and believe me, it will be enough. And then just that statement causes markets to rally so much that in the end, Draghi doesn't even have to do much of what he said he would do. This is the sort of amazing thing that you see from time to time. There are circumstances where I think that works especially well. And it comes back again to kind of theories of multiple equilibria. If you think that there are multiple equilibria in, say, Italian debt, so A high interest rate makes sense because a high interest rate, if it is sustained, makes it hard for Italy to pay its debts, and so you worry about default, and so the interest rate is high. But you can have an equilibrium where rates are low, because if rates are low, they can service the debt and there don't need to be a risk spread. Right? In circumstances like that, you can imagine the central bank making very strong statements that in equilibrium, they don't really have to do much. And the question, I think the really sort of interesting question this time around is the Fed basically comes out, announces it's going to buy corporate bonds, and it has this just dramatic effect on the corporate bond market. And is it that kind of situation? Well, on the one hand, there is some self-fulfilling effect, which is they announced this, and in the wake of the rally in the bond market, there's been enormous issuance. So companies have raised a huge amount of money in the private markets, which makes them better off, which makes the probability that they will default lower. So there's some element of the magic, but I think Sheridan, what you pointed to, I don't think all of that is enough to get us to the point where we don't have to worry about considerable amount of downgrades and defaults. And if that's the case, I do worry. I worry, I think Tobias was really highlighting this, have market participants overinterpreted the Fed's reaction function? In other words, the Fed has said under certain circumstances we'll buy certain bonds. I don't know that they stand willing. They may stand willing to buy bonds if the market becomes illiquid. Do they stand willing to buy bonds in the teeth of fundamental news? In other words, do they stand willing to buy bonds that have been downgraded or defaulted because the companies can't pay? I don't think so. At the same time, I think it's hard to rationalize some of the pricing. This is exactly Tobias's charts. It's hard to rationalize some of the pricing without coming to the conclusion that market participants think the Fed has their back kind of unconditionally. Now, normatively, that's a really good thing in terms of the short run, in terms of helping the market, in terms of getting a lot of issuance. It obviously sets up some risk down the road, because if we do get the fundamental shock and the Fed doesn't step up and do the buying that market participants have been imputing to it, then you get the negative direct effect and you get the disappointment effect, and you do worry about there being some market unwind. So, I mean, I think that's sort of the logical, inexorable worry that comes out of the kind of, charts and arguments that Tobias was making. I don't think we're in pure multiple equilibrium land where we can just think that saying it makes it so, and we can kind of not worry.
Yeah, no, I guess part of my point was your magic story seems to work very well talking about a financial crisis. It's harder to tell the magic story in the real crisis. And Tobias, can you comment on what we were just saying, because it's you're the one that raised it.
Absolutely, absolutely. Sorry, my laptop overheated, so I had to switch to my iPhone. So I dropped off for just a moment. So, I mean, what we see in terms of the real financial disconnect is extraordinary, right? I mean, the expected path of earnings is sharply lower today than it was in January, yet asset prices are at the same level. Now, this is masking huge sectoral divergences, right? I mean, tech stocks are up 20%, entertainment is down 20%, energy is down 40%. So let me make a couple of related points. So in terms of the overall valuation level, market participants seem to have accepted that when central banks do massive asset purchase programs, asset prices, even risky asset prices, are going up, right? And so there's a direct effect on say, the corporate bonds. And of course, the Fed is even buying high yield bonds, high yield bond indices, ETFs. But it's on the equity market that it's most striking. And so the risk premium has compressed very significantly. So one way to think about that is that there is this massive Fed put. And of course, if you have a massive Fed put, then your forward risk premium should be different, because you know that whenever something bad happens, the Fed is just gonna, buy whatever it takes. So this is sort of one story. But does it all add up, right? I mean, any asset valuation standard asset valuation that you run today tells you things are really overpriced. And well, is there the missing Fed factor to price these new risk premia? Is that sustainable? Is it sustainable for central banks to do this going forward, right? Think about Japan, right? I mean, Japan has been doing that, And asset valuation models in Japan have been flashing red for many, many years. But can the whole world do that? I think these are very fundamental, very important questions going forward. On the sectoral decompositions, I mean, as was pointed out, right? I mean, there are huge sectoral shifts. The economy is going to be subject to a lot of scarring due to insolvency, reallocation, unemployment, etc. So these are real costs. So no matter what you do on the financial side, these real costs are going to be borne, and sectoral reallocations, within countries, but also across the world, right? I mean, the whole global value chains are being rebuilt at the moment. So, very, very, very rich research questions here. And as was pointed out by Sheridan at the very beginning, I mean, this is an exogenous shock. So looking at cross-sectional responses relative to the shock is very rich. You can do it across countries, across sectors, across states, etc., depending on what data you look at. Finally, I think the 2008 crisis was all about bank insolvency, right? So the Fed injected liquidity, but this didn't solve the crisis. The thing that solved the crisis was to recapitalize the banking system, because unless you have enough capital, the economy is not going to restart. This time, it's similar. It's that, a lot of liquidity is injected. You can borrow, you can issue debt. Everybody can issue, even high yield issuers, sub-investment grade countries can issue. But this is an environment where your equity cushion is getting smaller and smaller and smaller. So at some point, there's going to be the problem that the corporate sector is going to be super levered, too little equity. Do you have to recapitalize the corporates? How do you go about that? At the moment at the IMF, we are running corporate stress tests, right? So similar to the bank stress tests, we do corporate stress tests to try to understand which corporates are going to be viable, which ones are going to be undercapitalized, so which should be restructured, etc. And I think governments are going to do this very systematically to figure out who to solve, who to wind down, who to restructure.
Okay, let me ask Jim to give his opinions on the disconnect. And also, Jim, if you've thought about this, in terms of the growing amount of debt, especially government debt, is there a limit to how much we can basically move into debt? We used to talk about, 100% debt to GDP sounds about the limit. Japan's gone to over 200%. Is this something that we should be worried about? Jim?
Yeah, thank you, Sharon. I mean, I very much defer to Jeremy and to Tobias on thinking about the broad macro issues here. The one thing I would just add to the commentary is, we are in these extraordinary times in terms of the return that investors seem prepared to expect, at least on riskless assets, which are the easiest place to try to measure what's going on. So in terms of simple, earnings and dividend discount models, when you're getting down to zero in terms of these discount rates, you can manage to buoy the asset prices even without a very big change in what the earnings stream looks like. Today I think the 10-year US TIPS return is minus 98 basis points. The 30-year is minus 34 basis points. That looks like a rich yield when you look around the world. The UK 10-year index-linked gilt is at minus 284 basis points. In Germany, it's minus 138. It's still minus 225 in the UK out to 30 years. So capital markets are in this really remarkable place in terms of what at least the riskless returns in real terms people are prepared to accept are. Equities are real assets, right? And consequently, you should be thinking about them in terms of these real returns over the long haul. And in many cases, as Tobias was pointing out, the sectoral rotation has pushed toward these tech firms, which are perhaps more buoyant in times of work from home and less interaction. So I think that's a key part of thinking about this. Of course, figuring out the equity risk premium in all this is really hard. And that's the place where if you've had both a decline in riskless rates and a compression in equity risk premium, then it becomes a little easier to explain how you might get some of the valuation effects that we've talked about. Okay, on Sheridan's question about levels of debt, again, I think we are in somewhat uncharted waters, in the sense that we thought 10 years ago the work that Reinhardt and Rogoff had done that there was evidence that if you got up around 90% debt to GDP, maybe stuff started to happen that was a curb on growth. You know, we're sort of moving through that that sort of guardrail and heading to higher levels. And I think the combination of you know, a lot. I mean, we're in many of the sort of developed economies, we've got an aging population. We've got a population that may be interested in holding more debt relative to equities and moving to safer assets. The safe asset shortage discussion that you know, a number of people have propounded recently for understanding what's been happening in capital markets suggests that there may actually be a demand side for this additional debt which is coming on forward. But I think, Sheridan, this is one of the very important questions. I'm not sure it's a great dissertation topic because in some sense it's a little bit of a speculative issue in trying to figure out what we do. But anyone who's got a good and clean way of trying to think about the consequences, the real consequences of these higher debt levels, this is a very, very important first order issue as we go forward. Okay.
We're going over time by a minute, but I'm going to just send it to Jeremy just to conclude, because Jeremy was saying that half the Harvard faculty is working on this type of research. Do you have any, you know, and be very brief, is this a good topic for our PhD students for their dissertation now? If they're not connected to special data or, you know, whatever else, you know, people are getting in real time at Harvard, is there slower questions that they should be working on?
I think so. I mean, I think Jim sort of touched on this just a second ago. I mean, obviously, you've seen now a lot of sort of quick hitter type papers, which don't feel maybe like they'll last in, you know, in importance beyond COVID. But things like this, when you push the system to its limits, you learn really about fundamental questions. We saw this in the financial crisis. It forced us to think about, on the finance side, all kinds of aspects of financial plumbing and financial intermediation that have since become pretty central to how we think about both finance and macro. And I think there are going to be a bunch of places, you know, the debt to GDP being just one of many, where there are fundamental conceptual questions, and where getting your hands dirty with the data is not just about answering the quick hitter question, but is teaching you about institutional realities that I think will inform kind of next generation models. So, you know, I have sort of heterodox views about it, but I kind of find it exciting to plunge into this stuff, and I think there are often kind of much longer run and more fundamental payoffs from doing so.
Okay. Well, thank you guys very, very much. I would have liked to have had an extra hour for more Q&A, but somehow we've run through our time very, very quickly. And I appreciate all the insights. I enjoyed this. And I'll turn it over to Scott, who will tell us where we go next.
Thank you, Sheridan.
Thank you.
Thanks to all of you
for this
terrific. Thanks to all of you for this terrific panel. And just add that as you exit here, go to your next link for the editors panel and sign in afresh. Thank you.
Thanks, guys.
Yeah.
Thanks, Sheridan. This was great fun.
Yeah,
Jeremy,
yeah. We should have had a little bit more
care.
time. That would have been good. But I really appreciate it. I found it very interesting.
This is great. Yep. Take care, everybody.
Bye-bye.